The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Ben Boulos. These are your headlines. Wall Street assemble. Nvidia pulls together one of the most ambitious lending efforts to date, with top names pledging over $500 billion in capital. Nvidia CEO Jensen Huang tells CNBC exclusively his chips will be their own asset class.
Nvidia's AI factory platform is really an investable asset, an infrastructure asset. And the reason for that is because it's productive, it's revenue generating, it is fungible, it's used by just about every cloud service provider.
Hopes for a Hormuz deal fade as both sides dig in. President Trump claiming 100% control of the strait, while also demanding Iran pays the US compensation instead.
They asked for money for the damage that we've done. I said, that's a good idea. Well, we're going to ask for money for the damage they've done over a 50-year period.
Well, that latest impasse in the Middle East sees oil prices tick higher and markets in Asia drift. Equity futures in Europe and on Wall Street are treading the flat line.
Nvidia has inked partnerships with 6 of the world's largest asset managers to source more than $500 billion in third-party financing for AI infrastructure. The Wall Street heavyweights joining the funding commitment include Apollo Global, Blackstone, Brookfield, BlackRock, KKR and Goldman Sachs. Under the terms of the deal, the groups will create dedicated pools of capital to finance Nvidia's AI ambitions at, quote, attractive rates for Nvidia customers. Executives from the 7 companies joined CNBC in a rare joint interview to discuss the announcement, with Nvidia CEO Jensen Huang hailing the partnership.
This is an extraordinary time, as you know, because this is the first time in some 60 years that the computing industry is going through a fundamental platform shift from the way that software was done before to the way that it's going to be done in the future, called artificial intelligence. Fundamentally, what's different about this industry and this way of doing computing is that the computer is now part of the infrastructure, like electricity, like the internet. And so you have to think about it like its infrastructure and build it out accordingly. Every company will be powered by it. Every country will build it. And so we're talking about an extraordinarily significant infrastructure build.
Nvidia has created over the last 33 years, coming together right now, but this is calling all precincts, because really now compute is an asset class. And when we think about the last 100 years, the last century of water and power and utilities, you know, in 2026 and beyond, the next decade, the U.S. will lead this. It's a global imperative, but it's a U.S. imperative. And as I said before, this is really all precincts coming together, not just one market of equity or debt or banks, but it's all. It needs any and all.
Oh, huge news that was breaking yesterday. Let's get to Arjun for more on this. Arjun, we've heard from Jensen Huang so much over the years talking about where he sees the industry going. Now this whole notion that compute is an asset class, we know Huang wanted to build factories, AI factories, these data centers. It's all happening with the big money behind it.
Yeah, look, I guess let's start with what problem here this is trying to solve. Data centers are expensive, GPUs are expensive, infrastructure is very, very expensive. Now Nvidia has this sort of consortium of finance partners. They can go to market and say, hey, I know our GPUs are expensive, but we have this very neat financing package to go with it if you want to buy them. And I think that's where it's a big benefit to Nvidia, I think most of all here, because Nvidia views, as you've mentioned, GPUs as this kind of infrastructure. And you heard it there in the sound, comparing it to utilities or other types of infrastructure we've seen in the past. And they've been calling these AI factories or these data centers a mode to produce tokens, AI models, AI services, and therefore the argument is the GPUs going into those factories are revenue generating and they're productive assets as well. And I think this could help Nvidia sell more hardware to perhaps smaller players who struggle with the financing portion of it, not necessarily just the hyperscalers who are also tapping in new ways of financing their growing infrastructure footprint as well, but also a competitive differentiator for Nvidia here versus AMD and some of the other players in the market, and almost reinforces the kind of lock-in that Nvidia has had in the market so far in terms of training as it continues to face more and more competitive threats to its model.
This is so interesting because we know that there's a real race to get towards AI infrastructure around the world. No country wants to be left behind, but everybody's considering the cost of the build out, whether they need this technology from Nvidia, whether they can build it cheaper using Chinese technology, some of the open weight models that are not just in China too, even in the United States. So this does seem to suggest that there will be access for countries that need this highly prized type of infrastructure still, even as the rest of the cheaper technology comes to market.
Yeah, absolutely. And I think even though the models are the model serving those models are getting cheaper, it's that underlying technology that still remains very expensive, the semiconductor portion. And there's lots of factors that contribute to that. One of those is the continued bottlenecks we're seeing across the sector, whether it's in memory, high bandwidth memory, which we know is a key portion of Nvidia's semiconductors as well that it sells in the big servers. So there's lots of things that are making this technology expensive. And so you're right, I think this financing package also gives other countries a chance to tap into it. But what's been interesting is even the hyperscalers, spending capex off their own balance sheets, are tapping things like debt markets now to finance this build out. And so you probably could even see some of the hyperscaler customers, the large big tech companies, tap in to some of this financing to build out a portion of what they're doing. I guess the other part here is this continues to build around the risk story, circular financing and some of the concentration risk that many have flagged within the industry, that actually if the life cycles of these GPUs are not as long as these companies are predicting, that could be an issue. If demand wanes, that could be an issue. So there's lots of ripple effects that could come as a impact of this if there's any kind of downturn as well. And that's the other portion of the story, I think.
I suppose the other thing this highlights is just the dominance that Nvidia has, because on the same day we saw Intel announce that in order to grow its prospects and to meet demand, it was going to issue another $15 billion of shares. Of course, more share issuance means the dilution of the existing shares. You expect the share price to fall a bit. But what was interesting about that is that, share price was falling as Intel is saying, look, we are trying to raise money to meet demand. Investors, perhaps less enthusiastic than when Nvidia announces this sort of commitment to build out.
It was a good time for Intel, I think, to raise money. Shares are up, I think, something like 400% in a year. So this is a great time for them to cash in while demand is still high. And then for Intel, I mean, they need to build quickly and they need to show that they can compete with TSMC in this portion of the market to manufacture the chips. I think Nvidia would love for Intel to be a competitive manufacturing partner for them, given how much of their production right now is concentrated with TSMC in Taiwan. So that's a really important part of the story, I think, for Intel to try to raise its capital, to build out capacity, to meet some of the demand from Nvidia and others as well. So it's certainly linked. I think for Nvidia here, the reaction was muted to some extent in terms of what they announced. But I think it's also, there were very few details around how this is exactly going to work, which I think, many in the market are still waiting to hear about how exactly is this, who's going to be the customers for this kind of financing. I think perhaps when we get a bit more clarity for that, you may see a different reaction on the shares.
Just a quick one to the point. Frontier trading life cycle of the chips, 2 to 4 years. Accounting timeline, that is 4 to 6 years. Yeah. So when you tend to depreciate the asset, right? But the operational lifespan of these assets, 5 to 10 years. So the financing arrangements no doubt geared towards something in that time frame, perhaps the accounting time frame.
Yeah, and over the last 2-3 years, there's been a huge debate over the usable life cycles of the GPUs. And, when that conversation started and we were talking about some of these new financing metrics where we saw sort of GPUs backing loans, etc. There were discussions whether actually these GPU life cycles was really short, 2-3 years. Now we're talking, as you mentioned, a lot longer time frame as well. And so, yeah, you expect to see some of those deals in that range. But also, I think the question is, as Nvidia brings new product to market, and it's on a very aggressive cycle as well, what does that do to the life cycle of the asset as well? That's another big question.
And don't forget, we've got CoreWeave coming out later on this week, so it'll bring up those duration and life cycle questions more. Thank you so much, Arjun. Let's push on to earnings. IHG Hotels and Resorts said that the trading in the US accelerated in the second quarter as it confirmed its outlook for the year. It comes as the company reported revenues of just over $2.6 billion for the first half of the year. I'm pleased to say Ellie Malouf has joined us, the CEO of IHG Hotels and Resorts. Ellie, thank you so much for joining us. Great to have you back on board. As we just rake over the trading that you've seen in the latest period, in the second quarter, the line here was trading has accelerated in the United States. You just want to unpick that for us. How has trading been across the portfolio?
Yeah, hi, Karen. It's good to be with you. Look, as you mentioned, we had a very good first half of the year. Our RevPAR was up 4%. We had 10% growth in EBIT, 13% growth in earnings per share, and we confirmed our outlook for the year. We feel good about the rest of the year and really beyond. The United States was a standout, not just because of the World Cup, but actually because of the underlying fundamentals of the economy. You know, your callers earlier were talking about strong investment in infrastructure and AI and data centers. That's hundreds of billions of dollars, but it's really broader than that. It's manufacturing, it's energy, it's pharma, it's all the reshoring that's coming into the country. So we think it's pretty broad-based. You still have pretty high employment levels, wage growth, GDP growing at 2%. Consumers are still spending, especially on experiences, and that's the industry we're really in. So we feel good about the United States continuing to grow. We saw positive growth in China. We saw Asia Pacific do really well, Europe do really well, and all that really helped make up for, some disruption in the Middle East, which is only 5% of our business, but the rest of the 95% of our business did really well, and we had a very good first half.
Ellie, I want to touch on the Middle East because you've also brought it up. You mentioned 5% of the system, but almost 20% when it comes to the EMEA portfolio. When we talk about the situation there, what are you seeing on RevPAR? Are you seeing that there's still very weak demand for some of these higher-end hotels?
Karen, I've been to the Middle East twice since the beginning of the conflict. I'm going back at least one more time before the end of the year, maybe more. When you're on the ground there, you see a sense of normality, things starting to get back to recover. We see it in our numbers. I think we're certainly past the peak of the conflict in March and April. And since then, it's been gradually improving. We think that continues. That's a very resilient region. People are very optimistic, and we're confident that when the conflict subsides, we're going to continue to momentum, but we continue to see improvement in the Middle East. That's 5% of our business. The rest of the 95% of the business did really well. We said in our statement today that we're confident that we can fully offset any impact if it continues in the Middle East for the rest of the year.
Ellie, let's get to some of those growth areas because we spent some time together at the new Six Senses hotel that you launched. Yeah. You showed me around the property. It was incredible. And it was a new move into some of the high-end urban estates. Let me just ask you about how that's going because you've had a record 443 hotel openings last year, so a very large pipeline coming through. What demand are you seeing in these new properties, the likes of Six Senses and more?
We're seeing very strong demand around the world. And Karen, it's part of really people's strong preference for experiences, over goods. People that are rising in well-being, rising in wealth, retiring, doing well in their careers around the world, the growing middle class, they want to spend more on experiences than they want to spend on goods. And we're at the heart of the experience economy. Last year, we opened over 440 hotels. Just in the first half of the year, we opened nearly 200. We signed another 2 new hotels into our pipeline a day, just about. In luxury lifestyle, of course, we've done very well. It's about 13% of our system worldwide. It's 21% of our pipeline, so there's 50% growth. But we're still growing very well in everyday mainstream brands around the world, whether it's Holiday Inn, Holiday Inn Express. Every single one of our brands in the first half had growth, had RevPAR growth, and the 200 hotels that we open around the world were still across all of our brands and our 21 brands in the portfolio. So travel demand was still very resilient in the first half of the year.
Eli, it's Ben joining the conversation here. I note from the commentary, you say there are ongoing impacts from the Middle East conflict, unsurprising there. We continue to expect these to be fully offset by growth in demand elsewhere, you said. I wonder, do we take that to mean that your strategy going forward is to pull back from the Middle East permanently and long term and really shift your focus to these other markets where you are seeing growth and things are more stable?
Ben, we're very confident that when the conflict subsides, we'll return to growth in the Middle East. We actually still signed quite a number of new hotels in the Middle East in the first half. We opened quite a number of new hotels. When I was there, I met with investors, with owners, with our team, with government officials. They're all optimistic. They continue to invest. We talked about a series of new exciting projects. So we're still very confident in the Middle East. We've been there, over 60 years, and we plan to be there for the long term. What I'm just saying is we're very broadly distributed. Our strategy is to be very distributed, very diversified globally in 100 countries, very diversified by brand and 21 brands from ultra luxury to everyday mainstream brands, very diversified by customer segment from business to leisure to group. So that's by strategy, by design. So whenever there's a disruption somewhere in the world, we usually make it up with the strength of the rest of the business. And that's what happened in the first half of the year, and that's what we think will continue in the second half. We're fully committed to the Middle East and to all the other regions we participate in the world.
Eli, it's impossible these days to conduct an interview without a reference to artificial intelligence. Lots of businesses are looking at it as ways to improve their margins or improve efficiency. I just wonder what ways IHG is using this technology, and can you give our viewers an assurance that AI won't be used by IHG to sort of add to the suspicions people have around dynamic pricing in order to effectively work out where people have a need for hotels and no other choice, and they end up paying more because of the calculations this technology can give you?
I'd say, first of all, Ben, we're a people business driven by people to create real live experiences for people. We do use technology very well to help our people make better decisions, do their jobs better, meet the responsibilities and demands of guests, and produce great returns for our owners. Artificial intelligence is one of the ways that we use technology. It's not the only way. We use it to reach out to our guests and customize their experience better. Just this first half of the year, we introduced conversational search on our app and our website so they could use natural language search to have a conversation and find the right destination, the right experience, the right surroundings for what they want to do. We use it to help our hotels, operate better, be more successful. And we use it to be more efficient in our corporation, to drive more productivity, to be more efficient. So it's really about making people more productive, making people have better experiences. We've been using all forms of technology, including artificial intelligence, to do that. So that's how we're applying AI at IHG. We also, just in the last few weeks, launched a mini app on ChatGPT, which is another form of technology people are using to search and customize their experiences to reach them where they want to be. Then they can book back on the IHG app or on our website, but they're searching on ChatGPT and finding their experiences there. So it's really to meet people where they want to be.
That's super interesting around AI. Let me also just kick the conversation over to FIFA. Looking at the wash up here, the implications for RevPAR growth for Q2, about 1 percentage point, you say, but also kicking across into the July month as well. Any learnings from targeting FIFA, because it's becoming such a big sports event and sports tourism certainly having its day at the moment?
Well, look, the World Cup's always been a major event, right? I'm a big football fan. I went to one of the games. I watched as many as I could while traveling around the world. I think it's very exciting. I think it was a great success. It brought people together in a friendly, peaceful, jovial way. People really got to experience the game and the tournament. I think it was a great success socially, athletically, and it was a great success commercially for us and for many in the industry. In fact, right here in the UK and in Ireland, you've got the Euro coming up in 2028, and we're very excited about that. We have, I think, the largest distribution of hotels among international companies in the UK and Ireland, and I think that's going to be another great event. It goes back, Karen, to the broader theme of people loving experiences, wanting to invest in experiences and spend their time in experiences. It's sports, it's concerts, it's theater, it's restaurants, it's bar, and hospitality is at the center of all that. So we do think that live sports will continue to power our business. I don't think it's just the World Cup. I think it's all the athletic events in between.
Just finally, let me get to China, because I know the market is looking to see whether the stability has continued through this half. And the numbers look so lumpy. Very strong first quarter. Second quarter came off a little bit, but still with some timing effects. But then if we drill down into the cities from tier 1, which looks strong, to tier 2 and 3, which looks weaker, it's hard to get a real handle on how China looks. So in your own words, how would you explain the demand and how sustainable it is in China?
Now, look, we're pleased with our progress in China. We've been in China over 52 years. We've reached 900 hotels in China with another 600 under development. We're going to reach 1,000 hotels, I believe, before the end of this year. The first quarter was very strong. It was favored by an extended Chinese New Year holiday. They added, I think, a day to that. Then you had some additional school holidays in the first quarter. So I think that pulled some demand out of the second quarter. We were still positive in the second quarter. That's 3 quarters in a row where our RevPAR has been positive in China, which is a reversal from 2 years before. When we think about China, we think about a large population where the middle class is growing rapidly, where the GDP is still growing between 4 and 5%. They're among the global leaders in technology, including artificial intelligence, EVs, batteries, record exports. So we look at the Chinese economy over time, we see a vast underpenetration of hotel rooms per capita. Some are like a fifth of what it is in the United States. We continue to grow in the market. Our profits are up 25% year on year in the first half of the year in China. So yes, our industry can be lumpy in a fast-growing market like China, but the long term still looks very good.
Good to hear, Ellie. Thank you very much for joining us and describing the earnings and the background to us today. We do appreciate it. Ellie Malouf with us, the CEO of IHG Hotels and Resorts.
Still to come on the show, hopes for a Hormuz deal fade as both sides dig in, with President Trump now demanding his own reparations from Iran. Dan Murphy will bring us the very latest. Plus, we'll look at the obstacles facing European tech. Arjun breaks down his conversation with ARM co-founder Herman Hauser. And the new UK Prime Minister kicks off his nationwide cost of living tour. John Stopford, head of managed income at 91, joins us to talk all things Andy Burnham. That conversation at 7:45 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone at CBE.
I started that first business of skincare. That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
So we saw the oil price jump yesterday. That has weighed on US equities. You can see the key benchmarks on Wall Street all finishing the day lower, decisively pulling back from some of the recent highs, the fresh highs that they have been hitting. And it has been tech stocks that have led the way lower. The Nasdaq, tech-heavy Nasdaq, being the biggest faller of the 3 key Wall Street indices. So let's take a slightly closer look at some of the tech stocks, the big names that have given up some ground in the session. And there you have it. Apple, Nvidia and ARM, all of those 3 retreating in the Monday session. We have seen the oil price really sort of weigh on equities, but we've also seen the volatility in the AI trade. Nvidia, of course, announcing that big partnership, and we'll see how that plays out when Wall Street trading gets underway for Tuesday. But in the meantime, let's take a quick check on the Asian markets. Japan's market closed for a public holiday, but here's how some of the others are performing. The Kospi having a better day than it's had recently, up around about 1%. And the others also trading the TAIEX up 0.4%, and the Chinese markets trading below the flat line. We'll keep an eye on those. And of course, we are counting down to the European market open in 25 minutes or so. Karen.
Oil in the US Strategic Petroleum Reserve has fallen below 300 million barrels, the lowest level since 1983, amid pressure on global inventories from the Iran war. Crude oil stockpiles in the SPR fell to 298.7 million barrels last week. That was a drop of over 6 million barrels. US President Donald Trump has responded to Iran's conditions to reopen the Strait of Hormuz, demanding Tehran pay reparations for what he characterized as decades worth of damage, while also insisting only Washington controls the waterway. And let's get out to Dan for more. Dan, so far we have a war of words, but that seems to be more positive for some of the Gulf states concerned about any further escalation.
That's right, Karen. Good morning to you. And a pulse check on how this is impacting the price of oil this morning as well. You can see here prices still mostly mixed. However, we have seen Brent returning to that 80 USD handle off the back of that war of words, as you put it. And it does seem as if the battle over who controls the Strait of Hormuz is really entering a new phase here. President Trump and Iran trading demands for reparations, and Gulf energy producers also now getting increasingly concerned that this disruption could become a long-term reality. President Trump overnight insisting the United States, not Iran, is in control of the strait, saying the US Navy is currently determining which ships can pass through. Here's the president speaking earlier.
The only one that has control of the Strait of Hormuz right now is the United States Navy. We have a blockade that's been infallible. It's a steel wall. And we let people in that we want to let in, and those people come in, and they've been coming in and they're going out. So it's actually open now. We do not let them go into Iran. They're not admitted into the strait to go to Iran. But it's open for others. Now, a little bit complex because they will, on occasion, drop a mine, and we find the mines. You know, we've mine swept the entire strait, as you probably maybe heard, maybe you didn't hear. But we control the strait 100%.
President Trump there. As for the Iranians, well, they have a completely different story. Iran says it won't fully reopen Hormuz until Washington meets a series of conditions, including ending that blockade of Iranian ports, but it also wants sanctions relief and compensation for damage from the war as well. President Trump, of course, said earlier in the week that he was low-keying his negotiations with Iran, also now responding with a reparations demand of his own. And in a Truth Social post overnight, Trump said he's demanding compensation from Iran for Americans killed or seriously wounded in attacks and conflicts involving Iran or Iran-backed groups. He also said that he said that demand will now be included in future negotiations with Tehran as well. So this is very much a war of words, and where it leaves who controls Hormuz in the future still very much hanging in the balance here. It seems as if there's been no immediate diplomatic off-ramp for the conflict emerging that markets would be hoping for. But at the same time as well, Trump's suggestion that he is low-keying this, also suggesting that he is prepared to wait, perhaps watching and waiting to see how the economic pressure continues to build on Iran and whether or not that lever of influence in terms of the economic side will have any impact on getting Iran back to the negotiation table.